Have you ever identified a perfect A+ setup? I mean, textbook bull flag, consolidation or pristine double bottom on the 4-hour chart. You're disciplined, you're good at managing risk, you've read Jesse Livermore, you've read Liar's Poker, you know the system, so you place your stop loss just below that swing low. You're protecting your capital, obviously. What happens next? You hit that green button, you're now long, you're in the market, you're ready, you've got skin in the game, you're ready for the breakout. And then, boom, the flush. A single, unprecedented, inexplicable, violent red candle spikes you down, seemingly ripping through your own individual support. It ticks exactly below your stop price. Ding, you're stopped out. Your position is liquidated at the absolute bottom of the range, almost as though Fibonacci and all those other technical patterns actually work. But not for you, right? For you, it's used to target your setups. But here's the kicker. Seconds later, the bid steps into the room. Hello, price reverses violently. It reclaims that level, and then it rips to a new all-time high without you. You are staring at your P&L like, what? That was a life-changing gain. But instead, it shows as a realized loss for you. We've all been there, I've been there, it happens. And you're wondering, is this market rigged? Is my broker stop hunting me? Is everything conspired against me? Well, the answer is yes. But not in the way that you think. You didn't just get unlucky, you got harvested. I'm not talking about organ stuff, I'm not talking about that kind of stuff. Slow down, guys, okay? In the next 15 minutes, I'm going to show you the level 3 data that proves why your textbook technical analysis is actually a heat map for high frequency algorithms. If you're still with me right now, do me a favor, give me a like, share and subscribe. My name is Justin Banton, this is the House of Trade. Let's get going, enough of that stuff. So, we are going to try to deconstruct the liquidity grab. We are going to expose how market makers view your stop loss not as protection, but as absolute rocket fuel, catalyzing their own positionality. Most retail traders think price moves are based on buying and selling. They are, but that's also kind of amateuristic to think about it that simplistically, right? Institutions know that price actually moves based on liquidity and inducement. If you don't understand the difference between resting orders and market aggression, that means you are the prey. If you don't realize who the sucker at the table is, it probably means invariably it's one of us, right? By the end of this video, you will never place a standard stop loss again. I'm going to teach you how to spot the swing failure pattern. Let's call it SFP, not SVP, not Sam Bankman-Fried, okay? But we're gonna learn how to do this swing failure pattern before it happens and how to turn a stop hunt into the most profitable entry signal in trading. So traders and tradettes, welcome to the liquidity trap. So, like always in my videos, I like to weave in a bit of a story. And this story, we are going to talk about trade out, breakout Bob. No longer Mike, we're going to do breakout Bob. To understand the mechanics of the crime, we need to witness a murder. Let's introduce our poor victim. Let's call him Breakout Bob. Breakout Bob is a retail trader. He trades patterns, he draws trend lines, he loves support and resistance, he loves Fibonacci's, he loves Bollinger Bands, he loves RSI, MACD, all of the good stuff. Bob is watching Tech Corp, some company, right? It's consolidation at $100 psychological level. This is the key support zone. So the textbook says, bid support, place stops below invalidation, right? Look for correction, look for continuation, and look for indications, all of that good stuff. But Bob has made a fatal error. He assumed that he is anonymous. He assumed that his order is invisible, but Bob is wrong. Breakout Bob is wrong, okay? Now, let's introduce the predator, market maker Mike. Yeah, Mike's back. You can't get rid of Mike, okay? Mike isn't just a guy in a Patagonia vest. Mike is a black box algorithm co-located on a server rack in New Jersey to minimize latency using high-tech physics to get his signal to the exchange before yours. Mike has one job, one mendacious mandate. He needs to fill a massive institutional buyer, a buyer called Vanguard. Dun, dun, dun. He needs 10 million shares. Here's the problem with institutional size though. If Mike just hits market buy for 10 million shares at $100, he will clear the entire offer side of the order book. He will cause massive slippage. He will spike the price to 110 instantly, ruining his VWAP, which is the volume weighted average price, right? Mike cannot buy until someone else sells. He needs massive violent selling pressure to absorb his buy order without moving that price up. He needs liquidity, and that liquidity, my friend, is me and you. No word of a lie, right? What does he see sitting at $99.50? Well, he sees a massive cluster of resting sell orders. Who put them there? Breakout Bob, obviously, and 10,000 other breakout Bobs who all read the same book, who all use the same indicators, and who all put their stop losses at the exact same obvious level. Mike's algo realizes that the liquidity he needs to enter is sitting right below the current price. So Mike doesn't buy, he sells. He initiates a short ladder attack. He aggressively hits the bid, $110, $100.05, $100 on the nose. He is pushing price down to unlock that treasure chest. Watch what happens when price ticks to $99.49. The cascade. A stop loss on a long position is functionally a sell market order. When Bob's stop loss triggers, when his stop triggers, his broker automatically dumps his shares at any price. Suddenly, millions of shares flood onto the market. Panic selling, capitulation, the price wicks down violently. And who is standing there with a bucket, absorbing every single share? Market maker Mike in the Patagonia vest, pressing that button violently and aggressively. He is providing liquidity to panic sellers. He is filling his massive institutional bag at a discount, using Bob's fear as the supply and everyone else's fear, because Bob's just not one man. It's multiplied and scaled up on tens of thousands, maybe even hundreds of thousands of traders. So once Mike's inventory is full, he pulls his sell pressure. The supply vanishes. The price snaps back like a rubber band. 100, 101, 105, 110. Bob was stopped out at the absolute bottom tick. Mike filled his order at the absolute bottom, right? Bob provided the exit liquidity for Mike's entry. Bob thinks the market is manipulated. Mike thinks the market is efficient. They are both right. It is because it's manipulated you into selling. Now, you might be thinking, okay, that sucks for Bob, but how do I see this happening in real time? How do I do it, Justin Banton at the House of Trade? You have to stop looking at price, okay? You have to start looking for the wick. So let's look at the mechanics of the actual hunt, of the actual game. You have to understand the difference between smart money, which is institutions, and dumb money, which is what they call us, right? We're not dumb, but that's what they call us. They actually call us dumb money, retail. Retail traders look for price validation. They want to buy when it's going up. Institutions trade based on liquidity availability. They can only buy when you are selling, literally, right? Think of a market maker like a whale swimming in a shallow pool. If the whale moves way too fast, he splashes all the water out. He needs deeper water to swim. Your stop loss is that deep water. This is why markets move from liquidity pool to liquidity pool. They're searching for it, right? Look at the chart. You see those long, nasty wicks protruding below support. Those aren't just lines. Those are literal, veritable crime scenes in the market. A long wick to the downside signifies a liquidity sweep. Price drives down, stops are triggered, liquidity becomes magically unlocked. Passive buyers absorb the selling, price rips way back up. If you are buying before the sweep, you are the bait. If you are buying after the sweep, you are the shark. This is the concept of inducement. The algo paints a pretty pattern. Look, a bull flag. Everyone get in. Put your stops right here. They are inducing you to create a liquidity cluster, but you don't know. But hey, it gets darker. If you're using a free broker that utilizes payment for order flow, or PFOF, you are literally handing your sniper, the sniper, your GPS coordinates. You're literally telling them where you are and where they can headshot you. Your broker sells your stop loss data to Citadel. Citadel's algos know exactly where the stop clusters are, and they're not guessing anymore. They have the map, they have the cheat code. So, is technical analysis a lie? No, definitely not. But retail technical analysis is definitely a trap. Support isn't a floor, it's a magnet. Resistance isn't a ceiling, it's actually the target. We need to reprogram our brains. When you see a double bottom, you think strength. The algo sees equal lows. It sees a massive pile of money sitting just below those lows waiting to be taken. So if this isn't conspiratorial enough, let's dive even deeper. So put on your Nvidia-shaped tinfoil hats and let's go deeper into the consensus trade. The market is a player versus player game, a zero-sum game, right? If everyone puts their stop loss at the exact same support level, that support level becomes a gravitational black hole. The price has to go there. It's the science and math, right? It's a mathematical imperative that it goes there. The market seeks liquidity like water seeks the lowest point, and like energy or electricity seeks the lowest path of resistance to go through. If there is $50 million of liquidity sitting at $99.50, the market will naturally gravitate towards it to facilitate that trade volume. So when you place your stop loss at the obvious level, the level every YouTuber told you to use, you are essentially putting a kick me sign on your back. You're putting a bullseye on your back for the sniper to come in and take your money. You are engaging in consensus thinking in a game where the winner is actually the contrarian, like by definition. So to perform and outperform, and you have to take risks that no one else is taking, right? And by doing the consensus, you are actually doing the antithetical of that. Now, the smart money knows you are taught to buy the breakout. So what they do this. They engineer a fake breakout or a deviation. They push the price just above resistance to trigger your FOMO buy orders. This provides the massive liquidity for them to short into your buying strength. Then they dump it. That's a bull trap. They push the price just below support to trigger your fear. You panic sell, this provides the liquidity for them to long into your selling weakness, and that's the bear trap. You aren't trading against just the stock, you're trading against the psychology of other losers in the same room. So what's the key takeaway here? Well, the key takeaway is don't be the liquidity. Don't be breakout Bob, right? How do we stop getting wrecked? How do we stop funding the market maker's bonus check? We have to stop thinking like retail traders and start thinking like a liquidity provider. Rule number one, you need to stop putting your stops in obvious places. If the swing low is 100, do not put your stop at 99.99. Everyone is there. It's just human psychology. Put it lower. Give it room to breathe. Average true range. Or better yet, rule number two, don't run for the sweep. Don't front run it, right? Wait for it. Don't buy at support. Wait for support to break. Watch the flush out. Watch the stops get triggered. Then watch for the reclaim. Try and trade that wave. If price crashes to 99, spot 50, grabs the liquidity and then reclaims 100, that is your entry. That is the swing failure pattern. You want to be the guy buying from Breakout Bob who is vomiting his shares. You want to be the one stepping in when fear is at the peak, the absolute apogee, right? The next time you get stopped out at the exact bottom, don't get angry. Don't throw your monitor. Don't wreck your keyboard. Smile. Because now you know exactly what happened. You didn't lose. You just got liquidated by a superior apex predator. You identified the liquidity pool. You just made the mistake of still swimming in it, right? So don't be the liquidity guys. Be the market maker. I'll see you on the good side of the order book hopefully next time. My name is Justin Banton. This is the House of Trade. Give me a share, give me a like, give me a subscribe. Don't be Breakout Bob. See you next time.